and welcome to Finextra. I'm Thea George and I'm here with Mack Gill from Torstone Technology. We're at Sibos 2017 in Toronto and we're talking about MiFID II. Mack, thank you for joining me.
Thanks, great to be here.
So tell us a bit about MiFID II and what it means for the market and specifically the post-trade obligations.
MiFID II has an ambitious agenda and it's looking to increase market competition, market transparency, and really help to shore up investor confidence, which is still needing to improve from the 2008 financial crisis. And so, again, there's a lot on the plate. There were 1.4 million paragraphs of text in the regulation, and a lot of that has needed technical interpretation by ESMA, the European Securities and Markets Authority. So there's a lot to work through, and still, we're here in October 2017, and there's still big questions like how research on bundling rolls out, the role of systematic internalizers. Interesting times is to be worked through, but specifically on the side of post-trade, it's really been all about data and how does an institution collect and cleanse and normalize a much wider data set of its trading activity, and then to do better analysis and reporting. And that's a challenge, especially if you look at still a very disparate systems environment, cross-asset that a lot of organizations have. And so really it's the data side, and taking it one step down, if you look at the obligations for trade reporting and transaction reporting, institutions really have to pick up their game. On trade reporting, within 1 minute, report on any transactions on any European trading landscape, and from a transaction reporting perspective, within T+1, provide a lot more information. Now, it is a big leap of information, again, from today's environment. Any European instrument traded on any, not just exchange, but any MTF has to be covered. And then you look at the amount of data required. We're going from 23 fields of information today to 65 fields of information, post MiFID II. So it really is a different environment, and that doesn't come very easily in terms of, again, normalizing that data and managing that in a cohesive environment.
Indeed, so substantial change. You mentioned that institutions need to up their game. Are they doing so? Are they going to be ready?
Generally, for example, with the UK brokers, when we work with a lot of them, I think generally things are going to be all right. The LSE came out recently with a survey showing that 11% of market institutions thought they were going to be fine, and another 2/3 thought they would probably be okay. And that, frankly, is a big improvement even from 6 months ago. So I think that there's been a lot of work, and I think that what we see is that a lot of our clients, and again, especially in the UK, are working together on areas that are still unclear for ESMA interpretation, but still providing kind of a collective approach. And so I think really what the challenge will be is post the go live, there's certain to be a whole range of new interpretations or clarifications. And so MiFID II isn't done on January 3rd. It's going to be a rolling set of work. But generally, I think that the market will be okay working together.
So does it matter if they're not? I mean, what happens? What are the penalties going to be like?
The regulators, knowing that there still are large areas of open to interpretation, I think certainly for the first 6 months of 2018, I think there will be a fairly supportive approach from the regulators. I think what institutions have to be doing is showing best efforts to adhere to the regulations, documenting exactly how they're doing that. They need to show and prove in a very audible way that they're doing the right thing. And so I think we'll see that type of open approach. But down the road in 2018, if you look at the current approach under EMIR, it has some teeth. And if you look back, basically there's a £1.50 fine for every line of bad data under EMIR. Merrill Lynch back in 2015 was charged $13 million for some issues. Deutsche Bank in 2014 was charged $5 million. So if you look at, that's EMIR. If you look under MiFID II, which is obviously a much wider footprint covering a lot more instruments and a lot more data required, I think there will be teeth to regulations, and it's going to be very important that institutions are ready and showing that they're complying. Again, a challenge for a lot of institutions, given their legacy environments from a systems perspective, And I think what we're going to see is a whole range of organizations thinking, we have to approach this moving forward in a much better way in terms of consolidated data, consolidated systems, cross-asset. So I think the era of putting Band-Aids on legacy systems to get through these things is over. And I think we're going to see a major investment cycle to be much more agile moving forward.
Which would be a very positive development, of course. Mack, thank you very much indeed. This has been great.
Thank you very much.
And thank you for watching.